Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, July 13th, and markets are serving us a buffet of optimism, oil anxiety, chip drama, and regulatory yoga.
Regulatory yoga already sounds expensive. If a bank says it is becoming more flexible, I immediately check whether my wallet needs a helmet.
Story 1. Bloomberg says investors expect sunshine and rainbows this earnings season, with stocks near records, but estimates are running into sticky inflation and rising odds of rate hikes. Translation? The market has ordered dessert before checking whether the kitchen is on fire.
So companies have to beat expectations, guide higher, control costs, avoid inflation, and smile for analysts. That is not earnings season. That is a corporate talent show judged by people holding calculators.
Exactly. For normal investors, the key is not whether profits grow, but whether the price already assumes perfection. If your portfolio is heavy in high-valuation growth stocks, this is a good moment to review position sizes instead of letting optimism do your retirement planning.
I mildly disagree with your calm tone. If markets expect rainbows, my first question is, who paid for the rainbow machine? And is it financed at a floating rate?
That brings us to story 2. Bloomberg reported a global tech pullback after South Korean chip makers sold off, while oil and bond yields rose after fresh Middle East strikes. CNBC also reported U.S. and Iran exchanging strikes as the Strait of Hormuz standoff escalated.
Simple version. Oil is the delivery fee for the global economy. When that fee jumps, inflation gets louder, bond yields can rise, and expensive tech stocks suddenly look like luxury subscriptions you forgot to cancel.
And for households, oil shocks can show up in gasoline, shipping costs, airline tickets, and grocery prices. For investors, higher yields mean future profits get discounted more harshly, which is why long-duration growth stocks can wobble even when their stories sound exciting.
But then story 3 walks in wearing a cape. CNBC says TSMC, the world's largest contract chip maker, reported a 68% surge in June revenue ahead of second quarter earnings. That sounds less like a wobble and more like the AI chip money printer found a second outlet.
I am going to push back. A 68% revenue surge is impressive, but strong demand does not cancel valuation risk, geopolitical risk, or supply chain concentration. It is basically like seeing a restaurant with a line around the block, then forgetting to ask if the rent tripled.
Fair. And story 4 shows the AI build-out is spreading beyond chips. The Times of India reports Spain's Submer plans a $2 billion investment in Madhya Pradesh's semiconductor sector, focused on advanced liquid cooling, with roughly 5,000 direct jobs expected.
That matters because AI infrastructure is not just glamorous chips. It is power, cooling, land, skilled labor, and logistics. For workers and investors, the growth opportunities may sit in boring-looking suppliers that keep the data centers from becoming very expensive toaster ovens.
Story 5. Bloomberg says the Fed's Bowman urged the Financial Stability Board to avoid strict rules that do not fit every country. I hear flexible global watchdog and picture a referee who brings both a whistle and a yoga mat.
The serious point is that global bank regulation has to balance safety with local differences. Too rigid and rules may not work across countries. Too loose and financial risks can migrate to the weakest corner, like water finding a basement crack.
Here is my reversal. I came ready to roast flexibility, but I get it. Still, whenever finance says, trust us to be flexible, normal people should hear, please diversify and do not keep all your emergency fund in vibes.
Quick recap. Earnings expectations are high. Oil and yields are the macro stress test. AI chip demand remains powerful. Infrastructure spending is broadening, and bank rules are still evolving. Action step? Review concentration, keep cash reserves sensible, and separate long-term themes from short-term hype.
And if your portfolio strategy is just sunshine and rainbows, maybe add an umbrella called risk management. Like, subscribe, and tell us in the comments which worries you more right now. Oil, earnings, chips, or banks doing yoga.